So we've invited Paul Salcone with Northpointe Bank here to talk about some non-QM. We'll tell you what that is in a minute, and portfolio mortgage products that are pretty versatile for today's market. Paul, welcome to the program.
Thank you, Emilio, for having me again today. I appreciate it.
Of course. Non-QM. First off, what does that mean, Paul?
Well, essentially, you hear that term non-QM and like, oh, what does that mean? And what it means is it's not a traditional, like, your cookie cutter mortgage that we're used to. I mean, say, for example, a conventional loan or an FHA where there are, certain guidelines that are more universal, maybe a certain time at your job, a 2-year job history, or maybe, a minimum down payment or a minimum credit score. So non-QM means it doesn't have those characteristics. It means this is for people who are the opposite of QM. So, for example, someone who is maybe self-employed, someone maybe that has numerous rental properties that don't always show positive cash flow, someone maybe who, credit is okay, but they have compensating factors that we can look at in addition to credit to base our, financing decision on. So that's what non-QM is, for people that are outside the box, are still quality borrowers and buyers, but yet maybe not the traditional way of getting approved. There are a couple programs that I feel, need to be talked about and certain borrowers will benefit from. In particular, I would say, one program I really like a lot is called the asset depletion. It's a non-QM program at Northpointe. So, for example, let's say someone who's, close to retirement age or even at retirement age, and they have a large 401k. We'll look at, when we qualify you, sure, we'll use the income you make on paper, whatever it may be, but we'll also look at your assets and take them and divide them by 84 months, 7 years. So if you had, $500,000 in the bank, we take that number divided by 84, and whatever that comes to per month, we use that as an income source, essentially, because at a certain point, we have to take the money out, the required minimum distributions. So eventually that money is going to be asset anyway, so we'll let you do it ahead of time. And as long as you have at least 36 months worth, so whatever you need to qualify, if we take that number, multiply by 36, as long as if there's 3 years, as long as you have enough in your account to cover that, we can use that income right away. Another one I want to mention quickly is called the bank statement program. Again, this program is geared toward borrowers who are either self-employed or have a business where there's, a decent amount of cash, but maybe the income on paper doesn't reflect what they actually make. So, for example, let's say someone who owns let's say a liquor store, a convenience store, a landscaping company where, each month on their tax return, end of the year, maybe the numbers aren't as much as what they would hope, but yet every month we can see their deposits. For example, they're showing cash deposits of, 8, 10, 12 grand a month, and we can see a 12 or 24 month history depending on the client. We can take the average of all their deposits for the year. Now, there's a certain percent we use. Obviously, based on the industry, we look at, okay, what's the typical profit margin? So if you're in an industry where it's, a high profit margin, then we'll use more of that deposit than others. But yeah, we'll look at that over a 12 or 24 month history and use that income, okay, a certain percent, say 40, 50% of whatever you deposit each month versus what you actually claim on your tax returns. And so that program is great for people in the cash industry, nail salons, even bartenders, different areas. We can use this program to help them qualify for a loan. And one more program I wanted to talk about a little bit, and this is more toward the investors. This one I actually do probably 1 or 2 a month, even right now as we speak. It's called the Investor Cash Flow, and this program is geared toward investors who maybe on paper have numerous investment properties where they show losses in their tax return. Well, how do we qualify them? They're very, they're great borrowers. They have write-offs. So what can we do to help them? Well, we have this program where we look at a property, let's say a 4-unit property, for example, and you have to put down at least 20%, which is consistent with most investment programs anyway. And we look at, okay, what is the anticipated cash flow? Either we look at, rental agreements in place, lease agreements, or we'll look at fair market rent that the appraiser determines. And at that point, let's say a 4-unit property, let's just make easy math here. Let's say it's $1,500 per unit times 4 units at $6,000 a month. As long as your mortgage payment, principal, interest, taxes, and insurance is at that number or less, you will qualify for the loan. So if fair market rent is $6,000, the mortgage is $4,800, guess what? You qualify. It's dollar for dollar. Some programs it's 75%. We take dollar for dollar what rental income is versus what the mortgage will be. And this program is a slam dunk for most investors. And we can do up to $3 million worth of loans. So we can do this numerous times. And we don't look at the subject property, everything else. We don't even look at W-2s, pay stubs, tax returns. All we look at is the property itself, what it brings in, nothing else. Wow. So it's a very good program for investors. I do it all the time in the Boston, Providence area.